I think we're fundamentally constructive. Obviously, we expect some volatility over the coming months, but the data continues to suggest that kind of the worst case scenario continues to be taken off the table, and we like what we see, and we're extremely constructive.
As it relates to what you directly invest in, mortgages, we can take commercial mortgage-backed securities for starters. And I'm thinking of that warning from Tom Barrack of Colony Capital, which feels like ages ago, but it wasn't that long ago, who was warning of a collapse in the commercial mortgage market. Do you share those concerns?
Well, let me frame. Relative to the value between residential and commercial, we are extremely proactive, and with $1 to invest, take our exposure in the resi space. I think there's certainly more uncertainty around the direction and the fundamental path forward on the commercial side, whereas on the residential side, the continued drumbeat of strong, the strength of the residential real estate ecosystem continues to make us quite constructive on the space.
Well, what you're saying is that, if you had to make a choice between the two, it's the residential space that seems to have more opportunity. Maybe you don't think things are perhaps as dire as Mr. Barrack views it, but you also sound like you're, assessing, if not sensing, some risk in that side of the market.
Yeah, look, there's certainly more uncertainty around, the forward progression of the economy and corporate activity and how that translates down to the commercial side. So certainly from a risk perspective, that element of uncertainty, we think, again, pushes that relative value conversation towards the resi side.
What about the issue of the Fed and how the Fed has come in so strongly and taken at least some of the risk off the table in things of the likes of which you're investing in?
Well, again, across most risk assets, you've seen direct response or a pretty rapid recovery of the dislocation we saw mid-March to mid-April. Again, an additional reason we're extremely bullish or constructive on the resi market is that's one of the few risk assets that hasn't seen such a rapid recapture of price. And so on top of what we think is quite fundamentally strong data, you've got some technical and tactical opportunities to take advantage of that.
Are you betting on a faster recovery in the economy, and thus that's why you're not so, well, I mean, I was going to say you're not so negative on residential. You generally think that that's a greater opportunity. Is it because you think the economy is going to bounce back and we'll get out of a recession faster?
I think it's more if you look at at the end of the day, these are asset-backed cash flows, and you can take comfort in the loan level credit analytics. And if you look at the price dislocation relative to what the data suggests, there remains some pretty opportunistic ability to capture value. So again, it's not so much that the long-term implications of COVID aren't going to be structurally damaging, but it's more if you look at how far at least our market fell, and how data continues to support the thesis that the market, the worst case scenario continues to be taken off the table. We expect to see some pretty rapid recovery in price.